Hey guys, welcome to this video. By the end of this video, you'll learn what liquidity is, how to identify it, and how to trade it in the Forex financial market. What is liquidity? Liquidity is simply areas of swing highs and swing lows on the chart where retail traders are willing to place their safe stop loss in order to participate in an institutional sponsored move. Now, these areas of liquidity are important as they are used to pair buy or sell orders for entry, which is popularly known as liquidity grab, liquidity sweep, or stop hunt. And on the flip side, these areas of liquidity are used as an area of target to take out buy or sell orders from the marketplace. And this is popularly known as draw on liquidity. Now let's go over the various kind of liquidity. Now the first kind of liquidity we're going to be looking at is the liquidity pool, also known as support and resistance liquidity. And this is series of equal highs and equal lows. So now we'll be looking for price to come and target this series of equal highs or equal lows and revert back into the range. So let's see what price does. So here we have it. So we can see our price ran the series of liquidity above this liquidity pool, pairing all the buy stops above here and trapping traders above the marketplace, now reverting back into the range. So now we want to see price hold up from this particular region, attacking the liquidity towards the sell side. So let's see what price does. And there we have it. So here we have another example of liquidity pool, also known as support and resistance liquidity. So here we have series of equal highs and equal lows. So we want to see how price is going to trade to this particular area as an area of target. So let's see what price does. And there we have it. So we can see our price trade aggressively from this region all the way attacking this series of high right here. And you can see even the rejection afterwards. The second kind of liquidity we'll be looking at is the trend line liquidity. So this is also known as a trend line phantom. So normally we expect a third touch around this area after seeing these first two touches. So let's see what price does. Boom. And we can see how price defouled this particular trend line. So here is another example on trend line liquidity. So now we've seen first touch, second touch. So normally we expect the third touch, but let's see what price does. And there we have it. So we can see even though price showed to respect the third touch for a while, it didn't hold up for too long, but reversed and defouled the entire trend line right here, which is known as the trend line liquidity. So the last kind of liquidity we'll be looking at in this video is the liquidity inducement. So we can see right here how price gave us a momentum to the sell side. So normally we want to enter our position at this particular order block right here. But you can see how price didn't give us the opportunity to do that. So price rallied aggressively to the sell side, but creating this series of liquidity. So sellers and retail traders went short at this particular area, keeping their stop loss above these various highs right here. So this right here is what is known as liquidity inducement. So let's see what price does going forward. So we can see how price rallied aggressively all the way back to that particular order block and sold aggressively. So this right here is liquidity inducement. So right here is another example on liquidity inducement. So normally we would like to take our orders at this particular order block right here, which is that down close candles, this series of down close candles high, but we can see how price left the order block and went higher, enticing buyers to enter long positions at these various lows right here. So we want to see price take out this induced liquidity reaching for this particular order block and rallying higher. So let's see what price does. So we can see how price reached for this particular order block high right there, and from then on rallied higher to the buy side. Trading liquidity could be very confusing, especially when traded in isolation without the context of market structure or institutional order flow. So let's look at an example of trading liquidity without the context of market structure or institutional order flow. So right here we have this particular swing high here, which is an area of liquidity. So we expect price to take out that liquidity and probably sell off. That will be the textbook approach. So let's see what price does. So price takes out that liquidity right there, and we probably will enter a sell. But let's see what price does afterwards. So you can see how price came aggressively, knocking out our positions if we had put our stop loss right there and coming down aggressively. So this is what we are going to experience if we traded liquidity without the context of market structure or institutional order flow. So now let's look at this same example using the context of market structure or institutional order flow. So looking at price, we can see that price traded higher, giving us a break of structure right here. So confirming that the market structure is actually bullish. So price retraced to the sell side, running liquidity here on the sell side and rallying again higher, confirming our bullish perspective in price. So basically, all we should expect is for price to keep moving higher. We only expect to see sell side momentum if price takes out this particular low right here. Otherwise, all we want to see is price to push higher. So even if price takes a buy side liquidity, we don't want to see price sell except it's break structure this low. Now the question is, why is this low? Because you can see price went high, broke structure, retrace right here, run liquidity, went higher, failed to take out the high, retrace again, running liquidity right here, then running higher. So this low becomes very significant because this is the low that push price to break this particular structure right here. So observing this same liquidity again, let's see how we would have approached it differently now that we have market structure in perspective. So we have a run on liquidity. Because of our market structure is still bullish, we are not going to sell. And now we have a bullish momentum candle coming right there. So instead of selling while we had this run on liquidity, we'll rather be buying right here, because right here we also see a run on liquidity below this particular low. So we'll rather be buying rather than selling. We can take our positions right here, even putting our stops below that low, and we can be aiming for this particular fair value gap right here. We can see before price actually sold aggressively, we can see that price actually took us in our profits at that fair value gap before actually reversing aggressively. Now, because price has broken structure right here, we can now anticipate to see price go to the sell side. Why? Because price took out this liquidity. So let me mark out this. So this liquidity now is invalid. Let's take this one out. So we have this new liquidity right here being taken. And since this is the low that pushed price to the buy side, running this liquidity, this low becomes very significant in market structure. Now that we have this low broken, we'll anticipate price to run lower because now the market structure is now bearish. So this is how you blend market structure and liquidity to be able to trade liquidity very profitably. So right now we can see that we have a break of structure right here. So all we're waiting is for price to retrace probably into this fair value gap, then we're going to sell further. And there you can see the moment price traded into that particular fair value gap, you can see how price sold aggressively all the way to the sell side. So this is how market structure can help you trade liquidity very profitably. So if you find value in today's video, hit the like button, hit the subscribe button, and see you in future videos.